Greetings, this is Milk Deriv, and this is another episode. And today, first of all, we'll say that this video is brought to you courtesy of Milk Deriv Group. And today, we're going to be talking on the boom and crash indices. It's one of the indices in Forex market. Remember that in indices trading, you can either trade the volatility indices or the boom and crash indices. And so in the boom and crash indices, we're going to talk extensively on what is boom and crash, and then how you can trade boom and crash effectively and successfully. At the end of the video, do make sure to subscribe and click on the notification bell to notify you once a new video is posted on the channel. The video is brought to you courtesy of Milk Deriv Group, a Forex-oriented group that helps with signals, account management, and mentorship. So let's go on. First of all, I'm going to say that the boom and crash, there are four indices in the boom and crash. There's boom 500, there's boom 1000, then there's crash 500, and there's crash 5000. They are synthetic indices aspect of Forex trading, and then these markets, they are the ones that stimulate the stocks. Remember before in our former video, that's the introduction to Forex market for beginners. The second one, we talked about that in Forex market that you can have indices trading, you can have synthetic trading, you can have stock trading, you can have the crypto trading where you trade the crypto currencies, you can have the stock trading, you can have the currency pair trading where that's the financial trading where you trade the currency pairs like the euro to Japanese yen, the France dollar to, and all those. That's for currency trading. Then for indices is, I would say, it's divided into the groups of things you can trade in indices. I would say it's divided into 5. You can trade the volatility indices, which is the most popular among them. You can trade the range break indices. You can trade the step index indices. You can trade the one that was just introduced by Deriv, the jump indices, and then you can trade the boom and crash indices. Remember that all these indices are only available for Deriv broker. You cannot use another broker to trade any of these indices. So today we're going to be talking about the boom and crash indices. Yeah, look at this is how they are. Quite strange in its own way, yet quite helpful and very, very educating. Like I said before, it's just an indices aspect of the Forex market. Is quite different from the normal trading of other markets. Very, very different. It's not the same way you trade. It's not the same way you see the volatility indices that you see the boom and crash indices. And it's not the same way you see the boom and crash indices that you see the range break indices. It's quite different. The range break indices is quite different. Now, what you normally see in the boom and crash indices are what we call spikes. Yes, spikes. They are what we call spikes. First of all, like I said earlier, we have the boom 1000, we have the boom 500, we have the boom the crash 500, and we have the crash 1000. Okay, so we're going to talk elaborately on it. Remember to turn on the notification bell so that you can be getting more videos here. So move in the boom indices. In the boom indices, that's boom. There's boom and there's crash. This is boom 500, this is boom 1000, this is boom 500, boom crash 1000, crash 500. There's going to still load. This is the boom index, and then this is the crash index. Now you will notice something in each of these trades. Now, what we normally say about the boom index is that the boom index is a selling market, and then the crash index is a buying market. If you can note it down, you note it. The boom index is a the boom index is a selling market, while the crash index is a buying market. Now, then there's lots of possibility for a spike, and then a spike a spike in boom index is a buy, while a spike in crash index is a sell. I'm going to repeat what I said. Said that the boom index is a selling market, and then a crash in the boom index is a buy, while the crash index is a buying market, and then the crash in a crash index, the spike in a crash index is a sell. It's just vice versa of what they are. They are just two opposite items, and they are not traded the same way volatility index are traded. Their lot size are not the same thing. They don't work the same way, because this ones maintain spikes, these ones have spikes. But you can always use price action to identify them and then know how to trade them. And I think that's it. Yes, so let's just go into what I mean. This is what I mean. We are in the index, and as you can see, it's selling. Yeah, the small candlesticks you're seeing there, makes it a selling market. And then being on a 1 minute time frame, if you don't understand what I'm saying, you can refer back to our previous video, Introduction to Forex Guide 1 and 2, where I talked about candlesticks elaborately so that you understand it. Right now, currently we're on 1 minute time frame. Remember, there's 1 minute, there's 5 minutes, there's 15 minutes, 30 minutes, 1 hour, and then the rest. Now, but we're on the smallest one. We're on the 1 minute time frame, and then the small candlesticks you're seeing forming after each 1 minute for a boom is sell. That means that it's a selling market. And then that's to say, if this candlesticks from here down to this place, follow the arrow from here all the way up here, if the candlesticks formed here is 30, that means that this whole stuff was formed in 30 minutes for a 1 minute time frame. Why this big one that you just saw here being formed is also formed in 1 minute, covering what was formed in 30 minutes. So that's what is called a spike. That's why it's called a spike rather. A spike occurrence can just happen instantly and then cover what a normal market would be very, very hard to cover for a very long time. Remember, I said earlier that the spike in boom index is a buy. The spike in boom index is a buy. The spike in boom index is a buy. The spike in boom index is a buy, while the spike in crash index is a sell. So what has been covered from here all the way down to this place. Let's assume that there are 100 candlesticks formed from here down to here. That means that in 1 hour, 100 candlesticks was formed within that time. And then look at what the spikes did. What that 100 candlesticks covered within 100 minutes. Just 2 spikes, we are able to cover it in 2 minutes. Now, one of the things people normally say, which I do not support, they'll say don't trade against spikes, and all those things. Markets, you are not detective of the market. You are not telling the market what to happen. You're rather assuming with verified price action analysis that this is what will happen in the market. So you telling me that I shouldn't trade against spikes means nothing, because I've seen markets that have sold boom 500 that have sold. I think boom 500 has been selling since 3 months ago. And then normally the spike is a buy, and people tell you don't trade against spikes, yet it's selling. And then by the time you now go for the spikes, you find out that your money is losing. So that's just it. Remember what we learned today? You said that the spike for a boom is buy, while the spike for a crash is sell. Let's go to crash 1000. Now look at this. This is the small pixels, the small candlesticks that are being formed in crash 1000. Now, unlike crash 1000, when we were in boom 1000, the candlesticks that were formed, they are red, showing that it's selling, and then it was descending. Let's go back to boom 1000. Reddish in color, candlesticks formed reddish in color, and it was descending, meaning that it's selling. The little candlesticks you've seen forming. But in crash 1000, it's rather a green and it's buying. And then the spikes you see there are this. A spike can be as huge as anything, and it occurs within a second. While the small candlesticks formed in either crash 1000 or boom 1000 or boom 500 and crash 500, those ones are formed per minute. Now we can use price action analysis to analyze any of this market. So before we say this to this, I'm going to say first of all, then the lot size for trading boom and crash indices. Boom 1000, the lowest lot size is 0.2. Yeah, I think so, 0.2 or 0.2, yeah, or 0.1. Let's assume I want to analyze this. Just an input drop trade. First of all, you go to the higher time frame and then get the overall trend of the market. And as you can see, this market has been moving up for a while. The market has been moving up for a while. Okay. So this market is going to sell. If you watched my former video, I said if you want to analyze the market, first of all, go to the higher time frame, find the general direction of the market, then you can come back to the lower time frame and then pick your entry point. It's quite easy. Okay, let's see. Let's looking for I've not analyzed this market before. Okay, so here there was a breakout and a retest. So of course the market is expected to sell. Market is expected to sell, and then here's a TP. Here's a TP. So let's do the same for crash 1000 if it's going to load well. Okay, sorry, this is not going to load well. But the main thing is for you to know the whole mindset behind the indices. What makes it different from the volatility indices is the fact that it has spikes. This one has spikes. They don't just move normally the way volatility indices move. The volatility indices and step index indices, they just move normally, zigzag and all those movements. Give an example. Let's check. I think this is ready. Volatility, any volatility, something like this. Moves where? Go to 1 minute. It's not moving with spikes. But in boom and crash, a spike can be as long as anything, and then we'll cover a very big range of what small candlesticks of the normal movement of the market of that boom is being carried. What I mean is that boom indices is a selling market, and then a sell can be going on for about 60 minutes, and then just one spike can cover the whole 60 minutes that the sell has been made for. Thank you. Remember this Milk Deriv group. Subscribe to the channel and